You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back to the Young Investors Podcast. Hamish Hodder, how you doing, mate?
I'm doing well.
We're seeing some interesting stuff going down in the markets at the moment. You've been following what's been going on?
My goodness, yeah, it's crazy. I just looked this morning. The NASDAQ, the tech index really is down now 17% from its highs that were set in November, and the S&P's down, I think, just over or just under 10%. So, wow, it's
right. Okay.
Yeah, we're really it's gone on for quite a while, this decline. Sometimes, more often than not, there's a bit of a decline for a week, and then everyone kind of gets euphoric again, and it kind of reverses. But how long's it been now? Maybe 2.5. Well, I mean, I guess the NASDAQ's been falling since November, so quite a while now. So yeah.
What's the technical definition of a correction? How much does the market have to go down for us to be classed as a correction? Probably like 10% or something.
Yeah,
but I
think correction is 10, and then people say a bear market is 20.
Okay.
So
right.
Yeah, but the S&P is nowhere near 20%. So
no,
we're not close to that. But yeah, I mean, it's mostly been driven. Everything is kind of down a little bit, but it's mostly being driven by like really speculative tech stocks that should have come off a long time ago. So
yeah, exactly. That's the thing. It's not really I guess it is a correction in a sense, a correction of all these tech stocks which have just been really, really expensive. But isn't it funny? Immediately on YouTube, just seeing all the recommended videos are now the market's crashing. This is what to do. It's like, if you think this is a market crash, then when the market actually does crash, wow, you're in for a world of hurt.
Yeah, well, the funny thing is that kind of content has been, it's always been just something that would get a lot of clicks. So you already, even throughout last year, like when the markets were going up, whenever there was a little bit of a down day, you would see these big creators saying the market's crashing.
Yeah, and now, down like
1%. What are they saying now? Just the same thing. It doesn't have the same effect if the whole year, every week you've been saying the market's crashing. So it's kind of a little bit of the boy who cried wolf for those kinds of videos.
It totally is, because like for the longest time now, it's been the videos that have been, it's been very popular to say all in your title or thumbnail. That seems to get a lot of clicks. All in this, all in that. It's like now what's the next trend? Is it going to be all out?
Yeah,
I'm all out of the market. I'm out. I've sold it all.
It actually, no, you joke about that, but I've actually seen a few people make videos like that that say I'm out.
It's just silly, isn't it?
Yeah.
It's just silly. But I don't know. Yeah. I mean, that's the thing with YouTube. It's half about like it's kind of sad in a way, because it's only half about the content you make, and then it's half about how well you can entice people to click on your videos. But I feel like there's a certain point where you kind of abuse the kind of all in or oh my God, the kind of sensationalist headlines before it is the man who cried wolf, and it's just nobody really cares anymore. Every time you do it, you lose credibility, don't you?
Yeah, exactly. It's a trade-off between, people make between getting clicks on this video versus a sustained audience that appreciate that kind of respects or believes that the title and thumbnail are reflective of the content. I think a lot of people kind of forget that, you might be getting, the YouTube metrics might look so good on the video you just made. But something that YouTube metrics doesn't show is like how people feel about your content when they see it on the homepage. What are they thinking? Are they thinking, oh, here we go again? Or are they thinking, oh, that's interesting. I know this person always, talks about what's in the title.
Yeah. It's like Richard Coffin playing Bagel. He never clickbaits, ever, not even slightly. But he still gets so many views on his videos because people just know that his content is great. So even though it might not be titled, oh my God, this, that, and the other, people just see his video coming up and they know they're going to watch a great video regardless of what the title is. So they click on it. So it's interesting. But then you get the other people in the complete opposite direction, which just make a lot of garbage content, but they know they'll get the clips they'll get the clicks because they just shout clickbait in people's faces. Anyway, Hamish Hodder, this is a very interesting topic, but it's not particularly investing related now, is it?
Yeah, no, we've got
earnings season, hey?
Oh my goodness, yeah, we've got. I mean, there's always so many companies to cover, but we're going to cover a couple of big ones because there's a couple of huge stories that came out this week. Tesla, of course, reported earnings, and you're going to take us through their results and interesting conference call. Is that what you said? There was some.
Yeah. Oh man. I mean, I'm a fanboy, but this conference
Really?
call was there was only like a few key points, so it's like 2 or 3 key points, but very, very interesting in relation of Elon's thoughts of the future of the company. So we'll talk a bit about that.
Yeah, and then I'll take us through Netflix, which is of course a massive corporation, and there's a big guru investor who just put over $1 billion into the company this week. So there's a lot to break down in terms of that.
If we get time, I'll do Apple as well, but we'll just see how we're going for time on this one because, this is going to. I think this is going to be a big one.
Yeah, I have no doubt this is going to be long as. So with that said, let's jump straight into it. Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker to Sharesight, or you can do it manually if you want by using Excel or manually entering in one by one. And once you've done that, it will track all of the different types of gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then the main reason why I personally use Sharesight and have been for, I think, over 4 years now, maybe even close to 5 years now, is for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. Sign up to a free plan, track up to 10 holdings for as long as you want, or you can also use that link to get 4 months off a premium yearly plan if you're interested. So it's a great deal. Go check it out. Try it for free if you want. And thanks to everyone who has used that link when signing up and is supporting the podcast.
Absolutely. All right, let's begin. Just quickly, we'll get this covered at the top of the podcast because I know you guys are probably getting a little bit fatigued of us just talking about all this Fed stuff and inflation and blah, blah, blah. And it's not particularly interesting either. But there was a bit of an update. Hamish, you want to take us through what happened?
Yeah, I won't ramble for too long, but the Fed meeting for January happened just over the past couple of days. They're keeping interest rates for this month at the moment at their same rate between 0 and 2.5%. Is the range, but they indicated that yes, they're still expecting to hike in the next meeting, which is not in February. They have a break, which is in actually March. Powell just kind of reiterated some of the things he's spoken about recently. He said the economy no longer needs sustained monetary policy support. So he's further enforcing that we're going to continue down this route of raising rates and that sort of thing. And his reasoning for that was the unemployment level is pretty much near pre-COVID levels. It's at 3.9% in the US.
Wow.
And there's also far more job openings than willing workers at the moment, which is actually driving the fastest wage growth in the US in years. So the Fed
that makes sense.
Yeah, and the Fed's kind of two roles is one to have maintain a healthy job market, and that it has been satisfied basically is what Powell is saying. And then the other is to maintain stable prices, which is certainly not satisfied at the moment. That is kind of inflation at the moment. So he's very much indicating, be ready. We're going to continue to be forceful when it comes to inflation.
So there will be a big focus on that March meeting because I think that's when the stimulus is wrapped up. Is that right? The bond buying is all over.
Yep.
I think that was in March.
Yep. Yeah, it should end in March. Yeah. Mm-hmm.
Yeah. We shouldn't. Like for all that we say about inflation, the Fed's not doing anything and they're sitting on their asses, not raising rates and blah blah blah. Pretty impressive that they've gotten the unemployment rate. I mean, it's not just the Fed, but they have managed to get the unemployment rate down to 3.9% from where it was. It was
in
looking
the double
pretty grim.
digits.
I think what was unemployment? It was up over 10% at one point, wasn't it?
Yeah, it was. Yep.
Yeah. So that's, I don't know. I can't remember what it was, but I remember like Ray Dalio at the time was saying this is like depression level unemployment. This is bad, you know?
Yeah.
So they've really clawed it back. And some of that would have just happened naturally, obviously, with reopening just after COVID. But it's also, you know, good job on getting the unemployment rate back down.
Yeah, a lot of the power has really, at least in the short term right now, has shifted back towards the workers, because even in minimum wage jobs, there's just such a lack of work that businesses are forced, if they're opening new restaurants, opening new stores, they're absolutely forced to offer better wages in order to attract workers, which they need to open these new stores. And that's what we're seeing, at least, you know, recently in the short term. So whether that continues, hopefully it does for workers. But that's kind of the environment at the moment.
Right. All right. Well, with that said, we got to talk about some earnings.
Yeah. Do you want
to? Where should we start?
I think you should start off. We should go through Tesla. Everyone wants to. I'm excited. I always love hearing you talk about Tesla. You're so passionate.
Boy, oh boy. Yeah, this is so passionate, Brandon. So passionate. Oh, the fire in your eyes. Should we start with operations or financials? What do you want? Up to you.
Maybe give us the operations, and then that can be a backdrop to the performance.
All right, sure. So we already knew about vehicle deliveries, 936,000 vehicle deliveries overall in 2021. So that was up from 509,700 in 2020. So that's obviously the biggest part of their business is their vehicle production deliveries. They also have the solar and energy storage part of their business. So they had 345 megawatts of solar deployed versus 205 megawatts in 2020. So a big jump in 2021. And they also had 3,992 megawatt hours of battery storage deployed in 2021 versus 3,022 megawatt hours in 2020. So another good jump there, but those businesses are just tiny, absolutely tiny compared to vehicle production deliveries. They also continue to grow their service network for their cars, which is to be expected. More cars means more service. Continue to grow supercharger stations. There's now 3,476 locations globally. So think of that like the petrol station. And then there's 31,498 actual supercharger connectors. So like petrol pumps. Yeah. So that's this is just by one company too. I should add. So pretty damn impressive that they've scaled that up so quickly. Yeah. And that continues to grow.
Yeah, you kind of, or at least I do, I kind of forget how many things they need to put money into. Just that, like, it's not just building a factory and then building those cars. It's also the service network. It's also the supercharger state. There's so much money that is just flowing into physical assets for this business, but they've been expanding at a massive rate. So props to them for that.
Yeah, they continue to expand very quickly. In terms of their gigafactories, so Gigafactory Texas is going to start producing 4680 battery cell Model Ys imminently, which is very exciting. So that is their new battery pack with their the structural battery pack. So that's basically a new. The car will, for all intents and purposes, it'll feel the same as the customer. It will feel the same, but the actual the guts of the car have changed in a way that means Tesla can make these cars much, much cheaper. So that's the big thing that everyone's excited about from an investor point of view, is that this new design of manufacturing the Model Ys is going to help them end up with much higher margins on those cars. So people are excited there. So Gigafactory Texas is getting going, which is exciting. Then Gigafactory Berlin is at the moment being held up by regulators, which is no fun, but they're ready to roll. They're going to begin making Model Ys with the 2170 cells, which is not the structural battery pack, not the new Model Y 2.0 as they're being called. Shanghai continues to pump. That's their kind of global export hub now. That's where all the Australian cars come from, is the Shanghai Gigafactory. Fremont continues to pump out all 4 cars for the American market. So it's setting up for an interesting year. 2 big new factories coming online. Vehicle deliveries should absolutely go through the roof. It's an exciting time if you'd like to follow the company.
Yeah. So is that all of the gigafactories that they have been working on? Do they have any other coming down the line, or were these the big ones that we've been talking about recently that they've been opening?
Yeah, these are the big ones we've been talking about.
Yeah.
Gigafactory Texas and Berlin, they're the new ones. Gigafactory Shanghai is pretty much done. It will just continue to ramp up and get a little bit better at manufacturing over time. But that was their big new factory, their first one outside of the US. That's all pretty good now. And now they're expanding to Berlin and Texas. Yeah. They said on the conference call that they will begin scouting for new Gigafactory locations this year. Okay. Hopefully announce one late this year, but they're really not looking at that at the moment. They actually say they can do a lot with what they've already got: Texas, Berlin, Shanghai, and Fremont. So it'll be interesting to see what they come up with. So that's kind of the Gigafactory front. Then we've also got full self-driving updates. So they continue to improve the full self-driving beta. Actually, one thing that was interesting that I didn't know is that in the quarter, the number of people on the full self-driving beta program grew from just a few thousand to around 60,000.
Oh, wow.
60,000 people are now scooting around with the full self-driving beta. So that's it's very interesting. And there's still yet to be a crash on the full self-driving software, which is pretty interesting.
Well, that's good. That's good to hear.
Only a matter of time. Because as more people get it,
Yeah.
But, so that's kind of the operations side of Tesla. Should we get into some financials?
Yeah. Let's do it.
Okay, financials. Q4 revenue of $17.7 billion versus $13.7 billion last quarter and $10.7 billion in Q4 last year. So they are growing their revenue quite substantially. Overall, 2021 revenue was $53.8 billion versus $31.5 billion in 2020. So, yep, again, trend is continuing, revenue growing. They had interestingly, 25.3% gross margin in 2021 versus 21% in 2020. And they achieved automotive gross margin of 30.6% in Q4. And that's actually quite significant because, like, for context, Apple is at 38% gross margin. So that's not too far. Like, there's still a gap there, but it's still not too far off. Like, Tesla's not actually that far from effectively selling like giant iPhones in terms of the amount of revenue that they get to actually keep. So I thought that was really quite interesting. Yeah. Very, very impressive gross margins. And then in terms of operating margins, so you include all the operating expenses as well, Tesla falls to 12.1%, but that's not bad at all. In fact, they've just taken the lead out of all the mass market car manufacturers. So 12.1% operating margin. They're ahead of GM, Toyota, BMW, Honda, Volkswagen, Daimler, Hyundai, Ford, and Nissan. So how's that? That's pretty impressive. I just think a few years ago there was so much criticism. How much criticism was there? This company is a really loose ship when it comes to their financials. They burn so much money. They don't care. It's just burning money, not profitable, blah, blah, blah. So I think that these numbers for this quarter really, and even 2021 show you that they've really tightened up now. They're really a pun intended, I guess, a well-oiled machine, considering there's no oil in Teslas. But I find it very, very interesting that narrative has totally changed. They've really got their ship humming, I guess. It's really going quite well for them.
Yeah, it really puts in perspective, I think, how quickly this transformation has happened, because it was, it was a couple of years ago they were in they had much higher debts. They weren't cash flow positive. They weren't running they didn't have as good margins as you just pointed out. And there was a lot of uncertainty, I think, about what was going to happen. Were they going to fix these things and become more of an efficient business? And every year they just continue to impress. So it's it's very good to see.
And on that note that you just brought up, how nice is this? This is a bit of a change. So now that they're making more money, just full stop, what did they say on their conference call that they're doing? This is refreshing. They are actually using that money to retire high interest debt.
Good.
They're not paying dividends. They're not buying back shares or doing all. They're actually taking the money and they say, look, we're doing pretty well now. Let's not get complacent. Let's secure the business. Let's retire our high interest debt.
Yeah.
Thank you.
Yeah, and
Thank you.
That's absolute necessity for this kind of business because as popular as Teslas are and how much they're expanding, it's still quite a cyclical business. A lot of automakers during tough economic periods will be losing money hand over fist for a couple of years or for a year or so. So to be in a position where you can reduce your debt and have a strong financial position prepared for those situations is absolutely critical for these businesses. Because what is it? Like there was only a couple of American automakers that haven't gone bankrupt, right? So that kind of just shows you how difficult of a business it is and how quickly it can get wiped out when there is some kind of weak economic condition, which is going to happen every few years or so. So that's good
Absolutely.
to see.
Absolutely. Yep. So no, it's very, I do like hearing that they've got their brains switched on and are retiring high interest debt. Very, very nice. Then in terms of net income, 2.3 billion, up from 1.6 billion last quarter, and up from, get this, $270 million last Q4.
Wow.
So overall they did 5.5 billion of net income in 2021 compared to 721 million in 2020. So that's a pretty good stat. I mean, probably needs to be higher for the valuation of the company right now, but still, I mean, that's an impressive rise.
Yeah, absolutely.
They're moving on a number that we care about a lot, free cash flow. So free cash flow, $2.8 billion in Q4 2021, up from $1.38 billion in Q3 and up from $1.9 billion in Q4 last year. So that gives them $5 billion in free cash flow in 2021 versus $2.8 billion in 2020. So they're ramping up. They're becoming more efficient. Higher margins, less capex per unit of production. They're starting to learn. They're learning and they're making their business better, and the numbers reflect that, which is good to see. And overall, they ended 2021 with $17.576 billion of cash in the bank, which is a very healthy buffer. It wasn't that long ago where they had $2 billion of cash in the bank. That was it.
Yeah, it's crazy. You mentioned valuation just before. Of course, they're still, very expensive compared to their current cash flow, but they're certainly, starting to fill out some of that valuation. I mean, it's a massive move from 700 million in net income last year to 5.5 billion. They're moving in the right direction. We'll just we'll see how far it can go and what they're ultimately worth.
So all of that information was taken out of the press release, the investor update, the quarterly update, and now we get to the conference call. And this is where things got very interesting because there was, as I said earlier in the podcast, there was only a few key points that were made by Elon, because Elon was back in this earnings call, so that was good to see. It's always nice hearing from him because he gives a lot more information. So there's only a few key messages, but I think these messages should really be noted by investors. So the most interesting thing is that Elon essentially thinks the two most important things for Tesla right now and into the future are full self-driving and the humanoid robot.
Oh, no.
Yeah, actually. So we'll talk about both of those, and I'll start with full self-driving. So he basically said that from his perspective, leading this company, He says if they were to nail full self-driving, then that is just a complete step change. That's just a massive change to their business. Like everything about their business right now looks like peanuts. Their current financials are almost totally irrelevant if they can get full self-driving nailed. And his reasoning is the reasoning he's been giving over the past couple of years. The cars will go from a utility of about 12 hours per week to over 5 times that. So if you could own a robo-taxi, it could generate a substantial amount of income for you. Thus, it makes the car, like at the moment, cars are depreciating assets. We just anticipate we're going to buy it for 50 grand and it's going to lose 20 or 30% of its value after 1 year of ownership or something crazy. But from his perspective, it's making the car become an appreciating asset, a more valuable asset, because it has software that gives it so much more utility. So he sees like a big shift in the industry coming. Like he was talking about how, I feel sorry for people that own car parks because car parks are going to be totally irrelevant in 10 years from. I'm like, wow, geez, he's got his head like 10 years down the track already.
It's unbelievable how far this guy looks into the future. Like I just read that first line you said when you're like, the two biggest things are full self-driving and the humanoid robot. It just makes me laugh because I can't even imagine what.
Because right now,
it just seems so far into the future, but it's once you do, I think Elon has a way of explaining the future or his vision for the future in a way that's kind of easy to understand. And it always wows you when you listen to him talk because he's absolutely right. I mean, that's a really good way of explaining it, that the utility of a car goes from about 12 hours a week from when you're driving it to pretty much all the time during the day. Regardless of whether you're using it. So it is an interesting way to look at it. And
So he was talking about that dynamic, like, will car parks become irrelevant? But also he was like, man, we're going to have a really massive traffic congestion problem because all the cars will constantly be on the road. And also he was like, the funny thing about Elon, he just speaks with so much confidence. It's like he's telling you how the future's going. It's like, no.
There.
Yeah, it's like I've been there. This will happen exactly. So he was talking about how people like public transport will become irrelevant because people just won't take public transport because autonomous electric vehicles will just they'll just dominate on cost. Like it will cost peanuts to travel on an EV, an autonomous EV. And it's also convenient because you don't have to go to a bus stop. You don't have to go to a tram station. You don't have to do any of that. It'll just pick you up from home, take you where you need to go. So he was saying like traffic's going to become a big problem. And it was just interesting. He was getting asked all these questions about, what's happening in the next quarter or the next year. How's the Cybertruck? And he was just basically laughing at all of them. He was just saying that they're these questions are. He basically said to the people on the conference calls, the questions you are asking make me realize that you guys don't get it. He basically said that on the conference call. Yeah.
It's so refreshing to hear someone talk like that because it's true. It doesn't even matter if you're making full self-driving or you're building 10,000 retail stores or you're expanding your whatever it is internationally. Like it doesn't really matter. Like it's the same thing. Like the next quarter is irrelevant. Absolutely irrelevant.
Yeah. So he laughed at everyone and said, look, your questions are totally irrelevant. You need to be focused on what our business looks like in 10 years when full self-driving is actually a thing. So that was very interesting. He's definitely bullish on full self-driving and he is definitely of the opinion that this will actually be like a serious game changer to their entire business. Like you won't care about how many cars we sell. As long as we, you won't be looking at how's the Gigafactory going. All you'll think about is just full self-driving. So very interesting there. And then the other big takeaway is what we said before is that he thinks that the humanoid robot, which he's codenamed it Optimus Subprime. I like that one. He thinks the Optimus Subprime is going to be Tesla's most valuable long-term project, which is insane. And it actually makes sense because he explained it at quite a high level, and he essentially said, money is an information system for labor allocation, and obviously the most important factor in any economy is increasing productivity. Like that's the key, that's the driver of economic growth, is increasing productivity. And in essence, our economic growth is limited by the fact that we as humans, we can only work so hard for so long.
Yeah.
So with that in mind, what's the value of a general purpose humanoid robot that's just programmable to whatever labor it needs to carry out, that essentially the robot completely eradicates labor constraints? Like, that is very valuable to an economy. So that's the kind of scale he was talking about. He was like, I think he said at one point, what even will be an economy at that point when, labor is carried out by robots and not humans and can just run around the clock? And if you need more labor, you don't have to have more babies. You can just buy another couple of robots. So very, very, very interesting. Very, very interesting.
Yeah. I mean, if you just use the US, for example, just consistently over time, we've just gone through this process of figuring out how to use less human physical labor. Just consistently, whether you're going all the way back to the invention of the steam engine and mass manufacturing that came out of that, to imagining a future where even finicky jobs that need a human, kind of an AI or a human to kind of problem solve on the fly with a unique kind of situation. I think you were talking about kind of some of the manufacturing parts in cars where it's just not possible to do with a robot right now, because it's easier for a human just to kind of place the piece in there rather than a robot doing it. Things like that, if they can go away, then that's massive. And I mean, we're seeing it in other industries as well. I mean, of course, people who at the register of restaurants and of supermarkets, that's going away very quickly. And there's just going to be this continued evolution of physical labor that is going away, and more jobs, I guess, in the management of those systems, whether it's a computer, the management of a computer, or the management of a robot or something like that.
Yep. Technicians, that sort of stuff. Yeah.
It's very interesting.
No, absolutely. I thought that blew my mind. So very interesting stuff. And then I think, so they were the first 2 points: full self-driving, the humanoid robot. And then the last thing is that Tesla won't anymore. They will not be introducing any of their new products in 2022 because of chip shortages, which is a little bit sad. But they actually say it's not that we're particularly, it's not like the chip shortage is horrible. It's actually improving, but they have so much demand for their pre-existing products that all the chips just need to go into pre-existing products just to meet demand. So it would just, from a business point of view, of course, from a consumer, it's disappointing, but from a business point of view, it would be silly trying to create a new product in 2022 when you could just do something. You've already made the production line for the Model Y and the Model 3, and if there's just a stack of demand for those that you can't possibly meet in 2022, then just put the chips in those and ship them out the door.
Yep.
Which is, like I said, from a consumer standpoint, I want to see the Cybertruck. I want to see the new Tesla Roadster so bad.
Yeah, I know. That would be great.
But
that's okay.
We'll just have to keep waiting.
We can wait.
It's all our own fault because there's too much demand. We need to stop buying.
I wonder when that'll kind of ease itself. I guess hopefully throughout this year. But I guess it really just depends on when this kind of short-term push of demand after the pandemic, when that starts to slow down, because that's still in full force at the moment. So we'll kind of see what happens with that. Yeah, I think that to me Tesla, I absolutely agree with Musk that if full self-driving is achieved, that their current business almost is irrelevant. Because the value of a car can go from whatever it is now to many times higher than that. It would, as you've spoken about previously, if it can generate you $50,000 a year, this is obviously quite a way out. But if it could, then the value of that car is now, you can think of it in the same way as some kind of like an investment property. Like if an investment property might generate $50,000 in rental income, and what would you be willing to pay for that property? Probably $800 to $1 million or something like that.
Exactly.
Maybe even more. So it completely changes the economics. The big if, of course, is if and when is that achievable? That's still, in my view, a long way away. I'm not watching this very closely as yourself and some other people like Gally, for example, but my view is that it's still quite a number of years away. But I don't know.
I would imagine so. I mean, there's just steps of the process. They have to get the technology sorted themselves, which they're, leaps and bounds. They're doing very well at the moment. But and Elon is he's been saying this for years, but he's again confident that they will have full self-driving in a pretty good state in about a year. But I mean, he's said that for quite a while. So whether you believe him or not is up to you. But that's not
good.
Yeah. But even if they say do that, then the problem doesn't stop there, because then you have the problem of getting it legal around the world. And I can imagine that there will be some progressive kind of governments that just read the data, see that it's safer, and say, you know what, this is smart. But there'll also be some governments that'll drag the chain as long as possible and might be incentivized to not let autonomous electric vehicles be allowed on the road. So I don't know, we'll see. But that's a whole nother problem. So I think when you combine the actual technology development plus the regulatory side of it, I think you're right. We're probably looking at many years still, but we'll see.
Yeah,
we'll see.
I can imagine it being legalized, region, not even region, really like location by location, because I mean, areas where the road lines and road signage is extremely clear, the Tesla or full self-driving beta performs much better than in areas where it has to think a little bit more critically. In those areas, it's still quite weak. So I can imagine, I definitely can't imagine a country being like, all right, you can use it anywhere you want. But I can imagine them saying, this area, we've looked at the infrastructure is very new. The lines on the ground are clear almost everywhere. So there's very little chance that the car has to make a decision where it's not sure. I can imagine pockets like that being legalized at some point in the next few years. But very exciting stuff. Very exciting stuff coming out of Tesla.
Yeah, definitely. All right. I've been speaking pretty much nonstop for about 20, 25 minutes now. So I think...
All right. That's all we've got time for today.
Thanks for listening, everyone. So I think I might wrap up. That's pretty much all I had to say for Tesla. So let's wrap that up. And now you can do the same to me on Netflix, because I'm very interested. Like, I don't look at Netflix and I go, "Ooh, investment opportunity." But I'm very interested in their business. I am a customer, obviously, and they've been tackling some challenges. So I'm interested to hear what they've kind of how it's played out over the last quarter.
Yeah.
So you want to take us through?
Yeah, it is interesting you say that I think that's been true for both of us for ever since we've been covering Netflix, is that it's an interesting business but not an investment opportunity. Over the past couple of weeks, that's actually changed a little bit for me. I actually have changed my view on how I think about Netflix, and I'll talk about that a little bit in this segment. Not that I'm investing in them and or anything like that. That's not what I'm saying. But my kind of how I think about Netflix has changed, and you might find it interesting. All right, let's get into some of their key numbers first. They reported their fourth quarter and full year results. So in terms of just going through some of their fourth quarter results, revenue came in at $7.7 billion, which is up 16% year over year. And that revenue figure is, of course, driven quite simply by two factors. One is the number of subscribers, and then also the average revenue per subscriber. Yeah. Pretty simple. So they added 8.28 million new subscribers in the quarter, which was an increase of 9% year over year, and brings their total to 222 million. So by far, they are still the largest streaming service. I think I was looking at some numbers just over the past couple of weeks. I think Disney is a bit over 100, 120, 140 million or something like that.
Yeah.
A little bit further down, then you've got HBO Max at about 70 or 80 million. And then a little bit further down from that, you've got the other smaller ones, Hulu, Paramount Plus, and a couple others I'm blanking on, that fall under the 30 to 50 million range. So
Stan.
I actually wonder those Aussie ones, how they kind of stack up. There must be so small.
I got no idea. Can't imagine there'd be too many. I'll try and find it. Stan.
It can't be, because I think Stan's only Australia, right? It has to be.
I think so. Wow. Okay.
How many?
There you go.
Something?
2.3 million subscribers for Stan.
Oh, dude. Yeah, so
it's actually more than I was expecting, to be honest.
An absolute speck on the map of
absolutely
services.
Considering how many people we got, like 25 million, 26 million, something like that.
Something like that, yeah.
Yeah, so it's not bad. It's doing all right.
Yeah, all right there.
Anyway, but no, definitely not quite a Netflix, are they?
No, and it was kind of interesting because I was looking at where that breaks down, because obviously they're dominant in the US. I think they have about 80 million or something in the US, which is massive considering they're only 350 million in population or something like that. But then outside of the US, they're not all that big really either. I mean, they have like 30 or 40 million in each of the three other key regions. So I was kind of looking at that and thinking, wow, there actually is potential for whether it's Netflix or some other streaming service to become a global giant. There's a lot of opportunity outside of the US that hasn't been capitalized on yet in Europe, in Asia, in particular. So that was their kind of growth, 9% on subscribers. They had a 7% increase in the average revenue per membership. So quite an even split between how many subscribers they contributed to their revenue increase and how much the raising of the price of the subscription. And then earnings per share for the quarter came in at $1.33, which was up just 12% year over year. So their margins contracted a little bit in Q4, and that was just the result of a lot of content releases that happened in the fourth quarter.
Right.
And then on a full year basis, which is a little bit more interesting to me than just a single quarter, revenue came in at $29.7 billion, which was up 19% year over year. For the full year, they added 18 million new subscribers, which was a lot less than their previous years. They'd been averaging about 25 million a year. But then in 2020, I think they did over 35 million because of the pandemic, and they got that massive pull forward. So if you actually combine 2020 and 2021 subscriber adds and then divide it by 2, it's perfectly in line with the two previous years. So it kind of, they actually were correct when they were describing in 2020, hey, we're getting a lot of subscribers now, but it really is pull forward from next year. That was absolutely pretty much bang on to their previous years in 2018 and 2019. And then for the full year, net income, so their profit came in at $5.1 billion, which was up 88% year over year. So a massive increase in their margins over the course of the year. And on a per share basis, their earnings came in at $11.24. So yeah, that's kind of...
So they're making money.
They're making money. And look, this is what I'm going to talk about when we get to cash flow. How much money they're actually making in terms of profit, leftover cash, leftover money for shareholders really depends on how you think about their spending on content. And this is kind of where I've had a bit of a shift in my thought process, because just to kind of get into their cash flow, which is what we care a lot more about anyway, free cash flow came in at negative $813 million. So they said they were going to be about cash flow even, and they were, quite cash flow negative. But less negative than in previous years. And I think, I usually had a laugh at Netflix. We always kind of were overly critical, I think, or at least I was overly critical of.
We like to poke fun at them.
Yeah, I used to poke fun at them. They had negative cash flow. They were loading the boat on debt. It was like, they took on $7 billion in debt this year and $7 billion that year. So I think I used to be kind of like, I never really thought, I think, about this number all that much. But here's something to think about. Before you get to that negative figure, within that negative figure, they spent $18 billion in 2021 on new content. So this includes the cost of production of film and TV, and then also the licenses that they pay for other content. But by and large, now they are a film and TV production company. And that's actually something else. I'll get to Bill Ackman's investment in the company, but something he spoke about management over the past 20 years in this company is it's kind of amazing how well they've pivoted, because they went from selling physical DVDs, renting physical DVDs in the mail, to then becoming an online streaming platform when bandwidth on internet was good enough. And now they're really a film production studio. Like that's three massive pivots, or three massively different businesses that they've gone through. So props to the management team over that time, which is still founder run, for managing to do that. But the key here, I think, about how you think about their cash flow is, of that $18 billion that they spent on content this year, and let's just pretend that their free cash flow was zero. Let's say it was negative, but let's just pretend it's zero. Of that $18 billion, how much of that is required to maintain their members on the platform? And how much of that is just extra expenditure that's driving more value on the platform and therefore attracting more members? And how you break down that spending on new content really decides whether the business is an insanely good business or a terrible business. So just to give you an example, if, let's say, of that 18 billion, if only 2 billion is what's required to keep people on the platform. So they spend 2 billion, they produce new shows, and that's enough to keep you interested in the platform. And then the other 16 billion is just free cash flow that they're deciding to invest in new content to grow the value of it. If that was the case, then they'd have 16 billion in free cash, and the stock has a cash flow yield of 10%. They have a PE of 10, basically. So that's kind of one end of the extreme. The other end of the extreme is, what if 16 billion was required spending? So they have to spend 16 billion on new content to keep you interested, or else you're going to switch to Disney Plus, or you're going to switch to something else. And 2 billion is their free cash flow that they're still deciding, we'll spend an extra 2 billion, try and make the platform better. Then it has a cash flow yield of 1%. So the business could be a great business or a terrible business. And it all really comes down to what you think of the 18 billion they're spending on content. So then you could...
Sorry.
No, go ahead.
I was just going to say that, that's very interesting. Can you read into... Because they have 222 million total, but they're only adding, 18 million... Is the 18 million new subscribers... Is it net? Is it net addition? So obviously you're going to gain some, you're going to lose some. Is the 18 million the net, or is that just 18? It is?
Yeah, it's the net. Yeah.
Yeah, okay.
Yeah. And I mean, the insane thing about Netflix is they have a retention rate of 97% on a month-by-month basis. So is high. Yeah. So most subscribers are staying in the platform. But yeah, that is a net figure. So that's their net additions. So
it's interesting to see, that you're right. It is just a case of how much is for, because that's what Buffett says. It's like you want to figure out how, it's the operating cash flow minus the amount of money needed to maintain the competitive position. So yeah, that's interesting. I'm not sure. I would say my gut would tell me that a lot of that would be in maintaining people on the platform, because they're not growing at a massive clip. They're not like adding a heap of subscribers, but yeah, who knows? And I guess that's the individual thing. I don't know this business well enough to figure that out, but yeah, I guess that's the thing you'd have to figure out.
Yeah, I would probably agree with you. I probably would lean on the side, and I'm not making a judgment about what this is on this podcast, but I would probably lean, if you force me, that most of it would be maintenance. I think there's in this kind of business, new content is king. People lose interest very, very quickly if you don't have new productions coming out and new seasons for the shows that people love. So there is a massive requirement on these kinds of businesses to put a lot of money back in. One way you can think about it is you can look at, how does Netflix think about this? How does Netflix determine what is used up in the business and what is extra spending? Because that, of course, comes into their calculation on the income statement. They were $5 billion in profitability. And the way that they get to that number is by making a judgment about how much their content assets get used up over time. So how Netflix does it is they amortize, which is just depreciation for intangible assets. So they depreciate the asset of a movie that they create or a TV show over 4 years. So essentially what they're saying in their calculation is, well, it's actually 90% is amortized over 4 years, but most of it is. So essentially they're saying that a movie that they produce, let's say they spend $100 million on something or $50 million, movie that they produce is basically worthless to users on Netflix after 4 years. So that's kind of their model for it.
So it's worth like 10%. There's 10% left after 4 years.
Correct.
Essentially.
Yes, correct.
Yeah.
And that kind of depreciates at an accelerating rate. So right as soon as it comes out, it still keeps most of its value. And then as time goes on, most of the value is eliminated in the third and fourth year, if that makes sense. So as time has gone on.
Right.
And if you use that model, which they do in calculating their income statement, they say that in 2021 of that 18 billion, 12.5 billion was required spending to just maintain, and 5.5 was essentially free cash flow that they decided to reinvest into new content to grow the value of the platform.
Interesting. By that model, it would say that Netflix actually isn't all that bad.
Exactly. And I mean, look, you compare, 5.5 billion to their current market cap, which is 160, they're still at a 30 PE, right? So it's not, it's not as good as if you made the decision that, 16 billion or 15 billion is free cash flow. But it does change your perspective on...
It changes it a bit,
on how you think about the business. And then you can kind of question, well, is 4 years reasonable? Does that make sense? Like, is a movie really worthless after 4 years? Is it sooner or is it later? I don't really know the answer to that question, but that's kind of how you can think about Netflix. And it's not, so that's kind of how I've changed how I think about it. Not necessarily that it's a good investment or anything like that, but instead of just looking at cash flow and saying it's terrible, how much of what's going into that cash flow is actually improving the service, improving the value, and essentially driving value for shareholders.
Yeah, that is a very interesting way to think about it, because I remember when Disney Plus first came out, I was just, you remember, I was of the opinion that Disney Plus is just going to take off. Like, the content is king. They've got literally content going back to the 1920s or 30s that they've got on Disney Plus, like all the way through. It's just insane, the library of content they've got. But when I logged on to Disney Plus, I watched a couple of old movies that, a bit of nostalgia, watched The Lion King, that sort of thing. But then I found myself, after The Mandalorian season finished, because I'm a big Star Wars fan, after The Mandalorian finished, I didn't really watch any Disney Plus. Yeah. Because when I break it down, my mental kind of space was, there's nothing really new coming out on Disney Plus that is interesting me, that makes me want to log in and watch something. Yeah. I knew that all of these great, Toy Story, all these movies that I loved when I was a kid, and I get a massive nostalgia, they're all there. The library's there, but there was nothing new. So maybe that is maybe that's, you've picked up on something quite important, and it makes sense because Netflix is also modeling that way. Maybe it is much more about new, fresh content, and that's why Netflix is still maintaining such a strong lead. They're in such a strong competitive position, because they have done that pivot and they are able to come out with a lot of fresh content. And I guess Disney Plus as well, because when they launched, they really didn't have that much new original stuff coming out, but they really ramped that up now. So interesting.
Yeah, it does make you think, because I was probably the same opinion. I thought, wow, okay, here we've got this Disney Fox content library going back decades that is just going to blow every other platform out of the water. And there's obviously a lot of value, I think, in older shows and having a wide library. So I actually probably think that maybe the 4-year model of after 4 years, it's basically worthless. I probably think that's leaning on the conservative side. I think there is value in, I like watching shows that are more than 4 years old. I do it all the time.
Right.
But there is there's definitely a massive massive emphasis on new content. And that does kind of change the way I think about Disney Plus compared to Netflix in terms of how they compete, because Netflix is putting out a lot of new content. But yeah, I just thought it was an interesting kind of mental kind of process to go through to continue on through their business. Debt, the company is still very liability heavy. It has been for a very long time, and they intend on keeping themselves quite indebted. And again, I've had a little bit of a shift in how I think about this as well. They have 15.8 billion in long-term debt and 8.2 billion in cash. So net debt of approximately 7.6 billion. And again, for a really long time, similar to cash flow, I would just kind of look at it and see how much it had gone up and just kind of laugh and just go, ridiculous company with a huge amount of liabilities. But then if you kind of think of it in, and you know, obviously it's still a lot of debt, but if you think of it in the respective, they spent $18 billion last year on content, and their revenue is it's recurring revenue with a high retention rate, then in an emergency, they're probably not going to have that much difficulty paying down their debt, considering they could pull back on content. Now, you wouldn't want them to do that, of course.
Yeah.
But in an emergency, are they scrapped for cash? Are they a business that would have to scrap around? I don't think they are, because they actually spend so much money just pumped back into content that they could just not spend on content and put towards paying down that debt. So that's kind of something to think about when it comes to that. In terms of content, of course, it's always interesting to look at how they performed in terms of some of their big shows. In terms of the top most Googled shows in 2021, Netflix series was 6 out of the top 10. And they had number 1, of course, which was Squid Game. Some of their biggest shows during the year, The Witcher had 484 million hours watched in the first 4 weeks. You had 468 million. Emily in Paris, 287 million hours. And then the biggest was Squid Game, which had 1.65 billion hours watched in the first 4 weeks, which is just crazy. That's an insane amount of watch time that they've achieved from that. I wonder how much Squid Game drove their business, from the third quarter onward.
True.
I wonder what impact that had, because it was such a global phenomenon. I mean, it's not even in English, and it was the biggest show ever. So it's
that's interesting. Yeah. It seems to be, I mean, even on YouTube, we're like, oh man, you hit that viral video and it means, one viral video could be worth half a year of regular videos. Yeah. So it is interesting that there's a lot of value in hitting the big viral, cross culture, killer TV shows, movies, series, whatever it is. There's a lot of value.
It's definitely an interesting outcome, because Netflix is, of course, pushing heavily onto Spanish content, Korean just content in different languages, so that they can capture these new markets where people don't primarily speak English. And a funny consequence, or maybe an unintended consequence of that, is that some of these shows have become extremely popular in the US and in English-speaking countries. I mean, I think another one was Money Heist they pointed to, which has had 7 billion hours watched, like in its entirety. And that's I don't know what language it's actually in, but it's not in English. So, that's a kind of an interesting consequence that you might not have expected, that shows that are huge in these non-English speaking countries could be huge on a global scale and still have a lot of value for English speaking customers. So that was kind of interesting. And then kind of in the backdrop of this, the stock fell about 30% this week because of weak guidance, and the stock has had these huge expectations for so long. I mean, the stock has just been insanely expensive. But midweek, Bill Ackman at Pershing Square Capital Management announced a $1.1 billion position in Netflix. He bought 3.1 million shares across 3 days, which is kind of it's a big purchase. I mean, I didn't even know you could buy $1 billion worth of stock in 3 days. So there you go. He was very aggressive about it as soon as the stock fell. And he posted about it on Twitter, and he shared a press release that was shared with his clients, and he gave his kind of reasoning for investing in the company, which I thought was interesting. So he gave a couple of dot points. He didn't really go into the details of the analysis or anything like that, which would have been lovely, but he gave some highlights. He said they're a highly stable, recurring revenue business with enormous growth potential. They have economies of scale. So as they get bigger, as they produce more revenue, their margins improve consistently. And they have deep competitive advantages on content production. He believes they have pricing power over streaming services. So an ability to consistently price their service much higher than competitors and still maintain higher users. They have an improving free cash flow profile, allowing for continued investment in growth and return capital to shareholders. So those were pretty much his main points as why he went into the business this week. So there you go.
He is getting it. He's getting it cheap. I'm just trying to see how far down it's gone. Wow, geez. Since November, it's down 44%.
Yeah, so it's come off considerably, and yeah, I mean, I think funnily enough, I was looking into Netflix prior to this, just after it fell, not related to the Bill Ackman investment at all, but it's that's kind of when I started to think, a little bit more critically about their cash flow, and it really does come down to that breakdown of that 18 billion or whatever they're going to spend in the next year. You might, if you somehow come to the conclusion that it's mostly growth expenditure, then it's insanely cheap. It's actually an insane business, insanely cheap. If you come to the other conclusion, it's still very, very expensive. So that is really where all the analysis lies, I think, with Netflix. The rest of the business is relatively simple. So interesting one. I'm going to definitely continue to explore it more because I'm finding it fascinating, and it's an interesting space anyway. Even if it's not Netflix, I think it's a great business model to have recurring revenue.
Absolutely, absolutely.
To look into Netflix deeper and then use that knowledge as a base to look into other companies as well, I think will be valuable.
Yeah, see what happens, eh? Wow, I just looked at the time. That's pretty much bang on 1 hour.
Yeah, I had a feeling we were going to both talk for about 25 minutes each on.
But I don't think what we were talking about, I don't think we really went on too long on each of the topics, or we rambled or anything like that. I think we actually just had good points the whole way through. There was just a lot to talk about for both Tesla and for Netflix. Yeah. So that was really interesting. I'm looking at the waveform, and the first half is all me. The second half is all you. So I think we'll wrap things up there. Just a reminder that, of course, we normally do our Q&A section now. So if you do have a Q&A question, we've still got them. We'll just get to them next week. So if you have a Q&A question, just head over to the most recent podcast on YouTube, leave it in the comments section, and we'll grab it, chuck it into the Google Doc, and we'll answer it in the next couple of podcasts, hopefully. But to be honest, we only got through 2 companies, and we didn't even get through Apple. We got a lot more companies coming out with earnings over the next little while.
We've got 498 left in the S&P 500 to go over the next one.
Yeah, we've done 498 to go. Oh, that's hilarious. But we'll see how we go. Busy time at the Young Investors Podcast. But thanks very much for listening, guys. We really appreciate it. Hopefully you got some interesting insight and information out of that one. Thanks always, Hamish, for joining me and taking me through what's the deal with Netflix. I thought that was very interesting today, so thanks for that.
No worries. Thanks for freaking me out about the robots again from Tesla.
They're coming for you. Terminator, IRL. Here we go. No, but thanks very much for listening, guys. We appreciate it, and we'll talk to you guys next week.
See you guys.